Welcome. Thank you for joining us today as we discuss how to improve strategy and positioning as a seller. Introduce myself briefly. I'm a managing director with MarshBerry. I've been with the firm for over a decade out of our California office, and I'm joined by my colleague Eric. I'll let him introduce himself.
Thanks, James. Hi, my name is Eric Hallinan. I'm a managing director here at MarshBerry out of our California office, and I've been with MarshBerry for about 15 years, focusing on investment banking, M&A work.
MarshBerry, if you're new to us, we are a global leader in investment banking and consulting. We recently joined Lincoln International back in October 2025 and are now part of one of the largest middle market investment banking firms in the country and globally. We have staff in the US and Europe, and through Lincoln, also staff in many other markets across the globe. Our focus is helping owners maximize the value and be in control of their destiny. We do that through market intelligence, through peer exchange. We have ad hoc consulting services specifically for wealth and insurance distributors, and we have transaction support for buyers, and we do sell side advisory as our core for the industry. The first point when it comes to improving your strategy and positioning when you're going to sell is the power of data and M&A and negotiations. What we commonly see is as when sellers, especially unrepresented sellers, go out and look to potentially receive value for their agency and liquidate the value of their stock, they do not have access to the data that the acquirers have access to. The acquirers are being fed data from real-time sources that track it, from investment banking relationships they have on Wall Street, from the fact that they've done often a lot of deals and know how those deals went, but whether those deals are represented or unrepresented, they have legal support. As a seller and entrepreneur, you will not have access to the data they have. When you bring on an advisor, we fix that problem. We'll talk a little bit about our data and what we bring to a process, but data drives your ability to negotiate. You might be a great negotiator, but if you don't know what you're able to negotiate, where you should be pushing, where you shouldn't be pushing, what trade-offs you should have based on what's gone on in the market, you're at a severe disadvantage to an acquirer.
Yes, data is currency, and you trade in that currency in this industry, just like you do when you're negotiating with your clients, or negotiating on behalf of your clients in delivering insurance or delivering wealth management services. The data you have makes you better at that task. It's the same on this side. We have so much data across all sorts of categories, whether it's related to value or structure, qualitative or quantitative, and all of that data allows us to be that much more powerful in the process.
Interesting, as we talk more about data, is the acquirers, the serial acquirers will pay for data and use that data, and they will hire advisors on the buy side. So it's interesting how often a seller might say, "I'm going to do it myself." Meanwhile, the expert is going to go get support. So what data does, if you use it properly, is it allows your advisor that'll have access to the data to benchmark with confidence against what's going has gone on in the market and what buyers have done historically. It allows you to anticipate what are the possible outcomes. If you have a desired outcome and you have certain things that are important to you, and you or your advisor go to negotiate those things, when you have data on everything that's gone on in the market, you can anticipate the way that certain acquirers or the acquirer, your preferred acquirer, is going to react and what's important to them and how to make sure you put yourself in the best possible light and increase the possibility or increase the likelihood that you get the thing that is valuable to you, whether that's extra compensation for yourself or employees, that's a bigger purchase price at closing. Maybe you want more equity, maybe you want less equity. There's a large number of things that you could be asking for in a transaction that having the data just makes it so you understand what's likely to happen and allows you to be intelligent about how you play your chips in the conversation. It also helps you set expectations. So you go in with the right level of expectations and you know whether or not you should even be having the conversation. Unadvised or with a bad advisor or with someone who's not necessarily being honest with you, bad expectations could cause you to burn a ton of time and enter down processes that you probably shouldn't have engaged in the first place.
Yeah, there are differences across industries, and you might get advice from someone who's experienced in another industry, and they're going to tell you certain things to negotiate for or certain things that you should expect, and they're just not relevant or real in insurance or wealth management. And that's another important factor is understanding the boundaries of this industry versus others.
So talking, we've mentioned it a little bit already, but our data advantage for our clients is we have the largest, and we know this for a fact, database of performance that have been underwritten by acquirers in our respective niches. We have the largest repositories of LOIs across the industries, and we have a large collection, probably, and maybe this won't be the largest because there's lawyered repositories that keep this, but a large collection of key legal points from past purchase agreements that's targeted on our industry focus. We often see attorneys pull benchmark legal data that's across all industries that often doesn't overlay with our universe or and your universe as our potential client of what actually happens in insurance and wealth. And so those having that data means that all our clients with us at their side are have leveled the playing field and in many cases are actually at a data advantage over the acquiring universe.
Absolutely.
So how do we know we add value? So we talked about the data and we know for a fact that the data is valuable, it's currency, and that we have the largest repository of data that anyone that does what we do. But in addition, because we have that data and because we have LOIs where we advised on the sell side and we have LOIs that we did not advise on the sell side, either the seller was unadvised or was advised by a competitor. When you look at total enterprise value, our clients on average between 2021 and 2025, and this is regulated, like the way that we do this calculations is regulated by our compliance department with here to FINRA standards. These numbers are not made up is 1.35 times revenue. If you're a $10 million revenue firm, if you hire us, on average, that has resulted in over $10 million of additional purchase price. Think $13 million of additional enterprise value, which is materially more than our services cost. With the return on investment for us, we represent around 10 times what we're providing to our fees, just to give you guys a sense of what our costs are and the value that we bring. I often tell prospects and clients is our services are free. I can't tell you how many stories I've had where clients have had offers on the table or had an idea of what value was from talking to buyers, talked to us and engaged us, and valuation very quickly increased by 30+% over the course of maybe a month or two after we were involved. We've seen it time and time again. Our data, our experience, our advice results in real dollars.
Well said, James. I don't think that there's much more to say other than what I don't want anyone to walk away with when they look at this slide is that they're going to get 6 times revenue automatically. There are a lot of components underneath this data. These are averages. And if you're a $1 million revenue shop, there's going to be something, a different set of benchmarks versus a $10 million revenue shop. But the magnitude or the stuff you see on the right hand side, the 1.35 times revenue and the 1,000% return, that stuff is relevant across all segments of those averages.
Yep, that's a good point. This is an average, and so the specific numbers, those are multiple revenue, would change based on size and scale and sophistication, but the differences or the magnitudes remain the same regardless of your size or similar. So, what are some strategies that we use to help maximize, protect value to a deal process? The way we think about it, we'll talk a little bit about the post LOI stage in a minute, but it's not just about drumming up interest in your business and getting high offers. It's about maintaining that interest and actually closing with those offers, especially in an increasingly volatile environment over the last 3 years. So one of the first things that we look at is we obviously will look at the business holistically and think about the way that a client approaches the market, whether they're personalized, commercial lines, large accounts, Do they have a commissionable sales staff, non-commissionable sales staff? Like, do they have special programs? There's a lot that goes into us deciding how an asset might fit in the market and who would be interested. Once we've gone through that layer, then one of the key things that MarshBerry does, especially well versus our peers, is we work to optimize the cash flows that we know a buyer will receive post acquisition. And there's sort of two ways that we see people do this wrong. Way number one is they're not represented and they go in with a cash flow number, an EBITDA calculation, well below what a buyer will run them at. So a buyer can give them a high EBITDA multiple that will result in significantly less proceeds than we would achieve if we were their advisor, or they hire an unsophisticated advisor that basically has no credibility in their adjustments. And so those adjustments won't survive through due diligence, and they're very aggressive, and they might receive a very high offer during the dating phase or the phase you're collecting offers. But during due diligence and to close, that offer is going to fall apart because the buyer is going to rightfully point out that their advisor, maybe in concert with them, put things in their pro forma and made adjustments that just aren't underwritable by their future partner. So we pride ourselves on, we very rarely outsource quality of earnings, is what it's called in the industry, and we focus on making sure that our clients have a defendable and sustainable cash flow stream that we know buyers can underwrite aggressively.
Yeah, and the fact that our process has been tested essentially hundreds of times every year allows us to have that credibility with those who are looking at it. And those who are looking at it are the buyers and the rest of the sort of buying community. And so when they see us present a pro forma and see us present a set of adjustments, they can have faith that those adjustments are backed up by something real and are sustainable.
So to think about it another way, we balance the need for your agency to grow post closing with an acquirer with what you need to have for cash flow, so profit, and then to make sure that you have the resilience, regardless of what gets thrown at your business in the future. So we balance risk and growth. What a buyer is looking at when they price your business is, what is the risk on the future cash flow stream, and that is discounted by the expected growth rate. The higher expected growth rate and the lower risk, the more that you get paid. Our job as an advisor is to make sure that those two things in the story that we're presenting to potential acquirers is optimized, so that the resulting EBITDA multiple, which is the resulting number at the end of the math that the buyer does in their internal spreadsheets, is as high as possible and as high as possible cash flow or EBITDA number. And so we spend a whole lot of time with our clients learning about their business, going deep with their business, spending the time to make sure that when we go to market, we have a strong conviction about the ability for our clients to do well. And the buyers can feel that, and they can reduce their ascribed risk rate, and they can feel good about the future growth prospects of our clients.
And you're going to see this come up several times throughout this talk, but the whole idea of telling the story and crafting a narrative, this is the story that we're trying to tell around risk and growth and the performance of the business into the future. And it's not in these terms. It's going to be much more relatable than that. But the point is to craft a narrative that as a through line through the data. So you're not just presenting data, but this is the key, the growth and the risk and how that all balances into the future.
One of the things that we bring to our clients is, it's important to, as you're thinking about trade offs between risk and growth, profit, value, the type of firm and culture that you're going to partner with, it's important to have what we would call a strategic governor. It's not a technical term, but what MarshBerry brings is, as advisors, we are that strategic governor to help our clients navigate trade offs prior to going to market, prior to talking to buyers. We've already done the scenario analysis, talk through what might happen, what might happen. We already have a tight range of the possibilities that are going to happen in the market based on our experience, so that our clients, when they get asked questions about things, that matter to the business, like what their comp will be, how long certain people are, might be with their company, if they're how much staff do they need. All those things have been thought through well in advance, and the trade-offs have been thought through so that our clients can tell the story that they have conviction about, that is going to best match with the outcomes that they're trying to accomplish.
It's all about managing expectations and setting those expectations and then making them come true. It sounds simple, and in a way, at least theoretically, it is, but there's a lot that goes into that.
So let's talk a little bit about the post LOI phase. So far, we've talked a lot about the data that we bring, the prep that we take into positioning our clients and telling the story to maximize value and to get strong offers that we believe and we know from experience will survive to the letter of intent. I do want to give, before we go into surviving the letter of intent, the one exception of where things go sideways post LOI is if there's a material change to your business. If you're $10 million in revenue and you lose $1 million of revenue after you sign a letter of intent, the terms will not survive. We do a really good job of protecting value in those negative situations, but ultimately, like, we're not going to be able to overcome a reduction in the business when it came to the initial valuation. So when we talk to our clients, part of what we strategize with them is where are they on their growth curves? Because the best thing that can happen post LOI is your agency grows. There's never a better time to win some of your large prospects than right after you sign the letter of intent. And this is something
I always
on in every deal, every deal.
I have a joke that I'll say, and it's like, "What's the best thing you can do during this process? Go sell some insurance." Right.
So once you sign a letter of intent, you're excited. It has a number you're excited about, a structure you're excited about. You believe in the culture of the acquirer. That is the beginning of probably the most grueling phase of selling your business. It's generally between 60 and 90 days, depending on time of the year and the complexity of your business and who the buyer is. And it takes longer than 90 days. Either your data is a mess or the buyer is a mess. So it's 60 to 90 days. And the buyer is going to test everything that we put together when we went to market. They're going to check your cash flows. They're going to look at your employee statements. They're going to look at legal filings and liens against your business. They want to know. They want to know how. They're going to look at your carrier contracts. They're going to want to know everything about your business because they are going to become the owner of that business. If we've done our job correctly, which we do, then that process, although grueling, the result of that process is going to be positive because we already know the direction that's going to go. But lots of things can happen during that process that are outside of anyone's control. You can lose additional revenue. What do? We work with our clients to make sure that's presented in the best possible way. You can have lawsuits, cyber breaches. You can have employees that don't want to come over, producers that want to leave. There's a lot of things that will happen or could happen post LOI that a good advisor like MarshBerry helps you navigate and helps you protect value through that process. Outside of things can change in your business, things can change in the buyer's business. We've seen this a lot over the last number of years. You can have interest rate hikes where their cost of capital goes up. They could have, a mandate from the private equity firm that their appetite has to change. And while we can't protect against every single anomaly in those situations, we have confidence of certain buyers and their word and their credibility in our trading relationship, where we can have those conversations and say risk here is lower, and then we can also help you understand where risk is higher and how to protect yourselves in those situations. And again, we have relationships that can make phone calls all the way to the top, and the deal flow that we bring is valuable enough to the market that it's a high bar for people to retrade or to do things to our clients, like pull out of a deal, that's already been agreed to. Those things are extremely rare versus what happens typically in the market because of the value that we bring to the ecosystem. We talk a lot about this. We're post LOI. We are proactive. We rerun your quality of earnings. We know if there's any shortfalls and issues often before the acquirers know. By the time they're calling us to tell us we uncover XYZ, we probably knew before they did, as long as you're communicating with us. And we probably knew before they did. And we've already strategized with you, our client, to make sure that whatever the impact is of the thing that has been uncovered, we've mitigated it or thought through how to mitigate it and make sure that value is protected. We use our database not just when we're collecting data or for negotiations, LOIs, we use it through the entire thing. If a buyer tries to move on a point that we know they've given every other firm, we have that memory, we have that data. And while we try to be very tactful, we're going to make sure that every one of our clients gets the best possible deal with acquirers consistent with what they've done with us in the past. And we stay in touch the whole time. We have a consistent feedback from M&A attorneys that we worked with that there isn't a firm, this is their words to us, they've seen be as involved post LOI to ensure that everything in the deal, whether it's legal, accounting, HR related, is done in a way that best helps our clients. We're interested that our clients retaining value in every area of the deal, and we get involved even in areas that maybe aren't our core to make sure that the core advisors in those areas have access to all the data that we have.
Yeah, signing an LOI is not a guarantee that you're about to get paid. What it is a potential. And we want to ensure as much as possible that that potential is realized to its fullest and maybe even optimized beyond what was originally negotiated. And our involvement is critical to that effort. Simple.
Yeah, and actually now, yeah, good point there, Eric, on the beyond. We have many case studies of where offers actually improved during due diligence, not necessarily on the multiple, but on the dollars and sometimes on the structure, because of our ability to continue to advocate for our clients based on positive information that developed post closing. So beyond the deal, so what happens after the deal? We stay involved not just through all the nitty gritty of due diligence and every single work stream that's going to happen there. We also stay involved with our clients through their earnouts with their partners or through their life cycle. They sell it to a financial buyer as they're growing with that financial buyer. We are interested in our clients' long term success. We will be the first person they can call throughout their time at their new partner about how should they negotiate anything that they might be negotiating. Anything that happens, we review their financial statements, we review their outcomes. And this means that our clients are going to continue to bring refer clients to us. They're going to continue to be a part of our ecosystem. And, if they go on and do something else in the future, they often stay in touch with us. But we make sure that our clients feel that support all the way through their partnership at the buyer. We don't just get our check, advisory check, and then walk away. We continue to support them as when they're partners at their new firm. So just to reiterate the some of the go back to the data point and why are we able to accomplish what we're able to accomplish. We've done more sell side advisory with the number one sell side advisor in the insurance distribution space for the last 25 years as marked by publicly tracked deals. And we have done deals with more buyers. This is going back the last 20 years than all our competitors. So we had the competitor names up here. Those are advisors that have a lot of focus in our industry. No one does more transactions on the sell side with a broader set of buyers than we do. We
And
don't have
so
any relationships with buyers that require us to take deals to buyers. We don't own shares in buyers as a company that require that we're like self-dealing. We make sure that we do not have conflicts in the market and that we can represent our clients individually on the sell side and ensure that we're doing what's best for them. And that results in a very broad selection of potential acquirers. The market is constantly changing, and we keep ourselves abreast of who is the best partner in a given year for the type of asset that we're representing.
and why is this really relevant? It's relevant for multiple reasons. A few include the data we get. We get this broad set of data from so many different buyers and so many different views of the buying appetites of different firms. So that's one quality. Another quality is one of our mantras is fit drives value. And so we don't typically conduct an auction and just send the data out to 100 buyers. We actually strategize with you around who might be a best fit Because if we start talking about fit first, it creates excitement and generates value, and the numbers usually follow that conversation. So that all those relationships and that broad buyer spread allows us to have um, just almost like an unlimited view of potential fits out there for everyone, because not everybody's the same. I mean, they might think they seem the same, but not everybody is the same.
Yeah, I mean, to that point I was saying, I had 3 deals that were referrals to each other, all friends, owners in one state, and all 3 firms ended up selling to 3 different buyers over a 3-year period of time. Because even though they were friends, even though they operated in the same state and they had some similarities, they were all fundamentally different firms and wanted fundamentally different things, and that resulted them matching with different parties. To reiterate a little bit more on the data, to put some brass tacks, in 2025, we completed deals with 34 unique buyers, and we had, LOIs was submitted by over 70 unique buyers. We looked at about 3.2 LOIs per transaction. Normally, our goal is somewhere between 3 to 5. We whittle it down. There's a lot of people that'll give us indications verbally, don't get to LOI stage, but we have a sense of, again, market and value. And because we have a database, we know we're pushing the market in valuation, or if the valuation is not there, and our clients know that along with us. One of the data points that's not on this slide is the average spread of an offer. We noticed that you saw the slide earlier. We talked about our involvement results in about 1.3 times additional revenue enterprise value. When we get offers on a deal, if we have a broad set of offers, the spread is over 30% between the highest and the lowest. And sometimes, and this is not necessarily clearly in the data, but Eric can attest to this as we're in the market advising our clients. Sometimes someone who was the highest bidder for 6 months is not the next 6 months. And so that can flip. It's often that we're seeing rotations about who has more demand based on time.
That's right, and having that broad sort of view of different parties out there allows us to, find those interested parties that are interested in actually submitting an offer, and you'll see that not everybody offers the same price. I mean, not everybody's going to offer the same multiple or the same structure, and that the spread has actually gotten wider over time as well. So certain buyers might be, for a certain asset might pay something low and somebody else might pay something high for the same exact thing, and we try to figure out, the right mix so that we can find that optimized offer.
Now, nothing tells me that someone doesn't understand valuation more than when they say, "What is agencies going for these days?" Like, the truth is your business is not a commodity. It's not like saying, "What are Ford trucks going these days?" Like, they're all very unique. All your businesses are more unique than any sort of commodity that you guys would normally buy and sell, and it requires someone who really understands the nuances of these businesses to make sure that the highest value for your business, if you're looking to liquidate your business, can be achieved.
Good point.
So, the key takeaways, just to summarize: information is leverage or currency. The acquirers have it, they will come prepared. Sellers should too. If you engage with MarshBerry, not only will you at least be on a level playing field, often and most time, our belief is you actually have an advantage over the average acquirer in data. They call us on a regular basis trying to get insights that we will not provide them versus what we provide to our sellers. A data backed strategy. Again, if you use data, MarshBerry, and to talk a little bit about us a little bit more as an advisory, and we mentioned we use data analytics on one of the early introduction sides. The core of who we are is data and analytics. The backbone of our company is a benchmarking service, and we've built that across every area that we consult in to make sure that when we're giving insights, it's not driven by emotion or what's popular in management consulting theory. It's driven by what is the data telling us. And we even tell our clients that's our bias, value and data. And so there may be reasons why you want to do something else, but the advice you're going to get from us is going to be backed up on what the data is showing. We believe that value is created through the process. When you go out to market and you run a process and you keep people honest, that drives value. One-off pot shots with conversations, buyers will, I'll love to get an agency owner on the hook who's unrepresented, and they again can often detract value 20 to 30% from what they would have had to pay if that agency was gone through a process where the playing field is kept even and fair.
Yeah, there are buyers out there that might be working sort of one-on-one with a potential seller, and as soon as they catch wind that that seller is about to engage in a proper process, they actually will say, "I'm out." And that tells you that their efforts and what they've been doing will not stand up to a process. So
Yeah,
that's how important the process is to creating value.
or even more unethical, they'll up the price because they know you're talking to an advisor, and they'll detract it at in the last minute during due diligence because of findings that you didn't understand how to defend against. So we see that as well. They're like, "Oh, you're talking to an advisor. They say you one times revenue. We'll give you an LOI at one times revenue. We have to prove it out." They're gonna get you involved and get you, yeah, a huge sunk cost fallacy. You're gonna get down the road, and then a couple weeks to closing or a week before closing, we've seen it time and time again. They're gonna call you and say, "Oh, we tried to validate that price, but we don't think the advisor could have got it for you, and we can't justify any either. Here's the financials that we're seeing, and we need to reduce that price by 20 to 30%." And they're back to where they started. We hear that story over and over again, which is why post LOI due diligence is high stakes. It's a lot of work. And if you're not advised through that phase, you are gambling with what's going to happen there at the end, where they have the time pressure you might have already announced. It was not uncommon that you might have already announced to your staff that they bring this stuff up to you. The final thing is trust matters. We trade on not just data and currency, but trust. We make sure that the people that we work with, that we are being honest in the market and that we are delivering on our promises. It's important that our clients feel that with us and that they feel that with the acquirer that they're joining. You need to trust your future partners because if you do not, you are not going to optimize the deal structure or the earnout because you will have to work together. This isn't a real estate transaction where you walk away. This is a partnership. And so the way that we negotiate, the way that we match for fit, the way we structure earnouts and help our clients achieve those earnouts post deal relies heavily on there being a mutual trust between the seller and the buyer.
Part of how we accomplish that, by the way, is allowing the seller to focus on all the activities that build bridges in relationships. All the stuff that, the excitement for the future, the prospect for, doing deals together and selling business together and growing together and all of those great conversations and meetings that can happen, and allowing us or your advisor to do the dirty work, to have those tough conversations when they're looking at purchase agreements or when you're looking at deal terms. That's so that you don't have to do the stuff that burns bridges or takes bridges down. That's separating those powers actually yields better results for the long term for sure.
Now, we are happy to be the bad guy to help you maintain a positive relationship with your future partner. If you have questions, we appreciate your time. Please reach out to Eric or I. We are very readily available and responsive and look forward to talking to you.
Yes, thank you very much.